Welcome back and thank you for still staying with us. Moving on with the program. South Africa enters tonight's State of the Nation address, Sona, with gross national debt above 70% of GDP and debt services costing or consuming more than 20 cents of every rand collected in revenue. At the same time, economic growth has struggled to consistently rise above 2%, while government has set a target of pushing growth just above 3% to drive job creation and investment. In last year's address, the South African government outlined plans to spend more than 940 billion rands on infrastructure over the next 3 years, with about 375 billion rands coming from state-owned companies. Certainly, this is a massive investment pipeline. And as we look ahead to the 2026 Sona, will infrastructure remain a central pillar of economic recovery? And how will government manage the delicate balance between debt control and growth stimulation? For analysis on expectations and what the address could mean for Eswatini regional trade, investment, confidence and economic stability, we're joined by economist Sanele Sibiya coming to us virtually. Mr. Sibiya, good afternoon. Thank you very much for your time. What should fiscal policy makers and the different countries trading with South Africa really be on the lookout for or watching closely in regards to the Sona?
Hi, Notsile, good afternoon to you and also to the viewer. So as we head into the Sona tomorrow, I think what we need to look forward to is kind of a balanced tone, a market-friendly tone coming through from President Ramaphosa. And also when you look at this is going to be the first time that we're having a Sona under a coalition type of arrangement. So we do expect a balanced tone regarding that. But then also we do expect President Ramaphosa to speak to the issue of debt and revenue mobilization and building that economic stability. So we do expect him to be pulling out from those gains that we have seen, with during that mid-term budget or the mini budget that Finance Minister Kondongwane actually presented sometime back in September, where debt was contained, government expenditure was relatively on the right path. And those are the gains, and also the revision of the inflation targeting bracket to the 3% with a 1 percentage point diversion. So those are the points that we expect him to delve into regarding the macroeconomic stability of South Africa, which has largely short markets and really just rallied around the South African markets. And also there was that improvement on the rating. So we do expect him to rave about those right now. Like in the first 6 months, that is what they've been able to achieve. And then in terms of the infrastructure, we do expect him to go into that as well. We remember last year, there was that $1 trillion, not trillion rand infrastructure investment package that, the government had touted at the time, and we do expect him to tell us what the plans are around that, because there are still investments that are expected around logistics. We need to make sure, he does need to make sure that the Durban Harbour works very well, the Cape Town ports work very well, the logistics, we do expect, talks around Transnet, Interfreight, railways, when you move things from the shore to within the country. Remember when this GNU came in last year, that was the major talking point around how do we improve the infrastructure. And then also what I'd expect him to talk around is issues of unemployment. Remember last year they posted 500 million unemployment package, So we do expect to see what's going to happen to that and what it mean for domestic industries and how are they going to seek to go around doing that. So those are the major economic points that we expect him to talk around. And it would be folly for him not to talk around issues of relations with New York and Washington and how he's planning to navigate those. But it is a big win for him, the fact that we've seen AGOA renewal and South Africa is on that list. So he is going to talk around those, and it's going to be yet another short-term win for this GNU. And then the biggest that I do expect them to dwell on, which is quite good for for Southern Africa, for the Southern Africa region overall, is the power stability. You know, in the first 6 months of this GNU, they have moved the power availability to around 75% of the time. And South Africa has not seen load shedding happening over that period, but there's also been stability, not only internally in South Africa, but also in terms of the power that they're able to export across the region. So I think it's going to be a relatively easy and a relatively beautiful Sona, because he has so much that he can tap into, albeit the fact that there are water crises. So we do expect him to also talk around that. How does South Africa ensure that there is a sufficient water supply in the Republic?
You've touched on infrastructure and debt, Mr. Spear. Last year, we saw the proposal of a VAT increase in South Africa that was then contested. These were actually or rather was among the aims or part of efforts to raise revenue in South Africa. Now, given that the government did target an economic growth just above 3%, and currently it's staggering at least 2% or below, can South Africa reduce its debt without either raising taxes or cutting spending, especially now, given the performance of the rand against the dollar?
Thank you, Notile, and I think I like the fact that you have touched on the strength of the dollar. That speaks to confidence in the South African market, and also what it does is it makes debt servicing relatively cheaper. So right now, you'd find that it's quite easy for the South African government to service their debts compared to when you needed 19 emalangeni and at times 20 rands just to buy $1. So right now they need 15 rands just to buy $1. So it makes the debt servicing quite cheap. And that when you look at the medium-term development strategy that we expect President Ramaphosa to be pulling from quite a lot when he presents his SONA, it does look into issues of structural reforms, privatizing that which can be privatized, and, running an efficient government. So once you find efficiencies, Notile, you are quite able to make it's going to be quite able to make the rand go stretch a bit longer. And at that point, that's where we're going to see whether he's that ability, we're going to see that ability to repay the debt while at the same time, having and freeing up money for these huge and ambitious infrastructure development programs. And then also, if you look at South Africa's medium-term development plan, 2026 to 2029, it does highlight quite a lot of private sector engagement therein to ensure that you can get private sector to come in and develop a lot of this infrastructure on a build and operate type of arrangement. That way, the entire burden to develop the infrastructure of the country does not fall on the government, but it is spread between the private sector and the government. So now, once you do that, you are able to tap into private funds to support infrastructure development in the country. And the fact that we're seeing growth near the 2% target in South Africa, now that's a milestone. If you recall that South Africa has been hovering around the low 1%, 1.2, 1.3% over the past, past 10 years or so, I think. And they've only seen growth until the 2010s, and then thereafter there's been staggering on that level. So it is quite attainable. And the fact that they've been able to finance the government right now without that additional 1% in VAT, it does show that once you can do a lot of pushing around and pulling around, you're able to find the money if you're efficiently doing what you need to be doing.
I appreciate you proposing, Mrs. Spear, that the South African government should be taking advantage of this dollar weakening so that they're able to settle their debts. But with that in regard, what does a stronger fiscal position in South Africa mean for investor confidence in the region, seeing as South Africa is one of the biggest economic players, not only in the African continent, but also just especially in the region? What does it mean for the region? What does it mean also for our trade relations as the kingdom?
So we do expect as a kingdom to get a lot of those windfalls coming through from our CMA arrangement, that is the Common Monetary Area, coming through from the Southern African Customs Union. That's where we get a lot of our revenues from as a country, and also coming through from the SADC arrangement. So there are a lot of arrangements where we are so intertwined and so interlinked with the Republic of South Africa. So stability in South Africa not only anchors, stability in the Republic, but it also anchors stability in the kingdom, because by default, once South Africa starts targeting a lower end spectrum of inflation targeting, then we are expected to follow suit as CMA countries. So now that speaks to overall and broader stability and convergence within the bloc. And then also, once we see the South African economy growing, because whenever you model the GDP growth of Eswatini, you always have to factor in, the growth prospects in South Africa. So a growing South Africa is also going to be inadvertently a growing Eswatini. So that stability in South Africa is going to anchor stability in the kingdom, because if you also look at the anchor in our currency, it is anchored to the rand, and a weaker rand also means a weaker monetary policy position in Eswatini, and a weaker fiscal position in South Africa also means somewhat of a weaker fiscal position in Eswatini through the SACU channel. So we have the CMA channel and the SACU channel that anchor us to South African economy and integrates us to that. So positive news in South Africa are also positive news for Eswatini.
Thank you very much, Mr. Spear. While we still have you with us after the break, we're going to have a chat on markets today. Stay with us.